Hey, this is Tom Nash. Welcome back to the Value Investor by Tip Ranks. And today we have an amazing video for you today. We're going to talk about something else that is not Russia or Ukraine. Because meanwhile, while everybody's focusing on what's going on over there, we still have an inflation problem over here, which means we have a lot of opportunities because every crisis is an opportunity to make money. And I believe there is money to be made. So stick around with us. This is going to be a good one. So thank you for staying with us, and let's talk about inflation for a change. With all this overdrive and hyperinflated news about Russia and Ukraine, we almost have no news about the Fed, inflation, and none of the stuff that we were talking about daily just a few weeks before. Now, I'm sure Jerome Powell is happy about it. Why not? But the thing is that inflation didn't really go away anywhere. The fact is, it's here and it's probably worse than ever. Now, obviously, that's not good for the US economy. That's not good for the stock market. But in every crisis, there's a zero-sum game. There's always money to be made. And I believe that the best opportunity to make money during an inflationary cycle like we're about to experience right now is by investing in the banking industry. And at this point, a lot of you are scratching their head asking, well, Tom, how do banks perform better in inflation? Why would they not suffer from inflationary deflation of the stock price? Well, essentially, banks lend out money, charge interest, and that's how they make their profit. Now, in inflationary times, the Fed is bound to raise interest rates. It's inevitable. It's not a question of if, rather than a question of when. And we know this for a fact that interest rates will go up. There's a whole debate of by how much it will go up. But we know interest rates will be elevated. There's no way escaping that. And that's basically giving the banks more profit margin because the higher the interest, the more they charge. Simple as that. Now, everybody knows it. We have a free flow of information. That's why bank stocks have been doing exceptionally well because people are prepping for that exact thing. So what we need to be looking at is actually looking for the undervalued plays. You know, Warren Buffett once said, when everybody's greedy, I'm fearful. When everybody's fearful, I'm greedy. The same applies not to just macroeconomics and the stock market in general. It applies to specific companies. We have to find the diamond in the rough. The company that's nobody looking at and everybody actually repeats and parrots some negative narrative, basically pushing the price way lower than where it should be. And in this case, I'm talking about Citigroup. Citigroup is exactly that, in my opinion. And I'm going to make a case why. So Citigroup is basically lagging behind the industry. They're lagging behind Bank of America, JP Morgan, Wells Fargo. There's no doubt about it. In fact, they got slapped with a mega fine, $400 million just in 2020. There's a whole new management. They went through this crazy bad time. There's no doubt about it. So they're definitely the ugly duckling here in the story. But they have been turning things around. We have new management. They're actually getting rid of the excess weight. You know, like a fighter, reducing weight to be more agile and have a little bit more stamina. They've been doing that. So they're basically getting out of retail that's not in the US. Any non-US retail, they're basically selling out, and getting themselves more fit to fight on the corporate side of things, which is where the big money, I think, is. At least that's what the number tells me. Now, here's the thing. They're not as good as any of the guys I told you. They're not as good as JP Morgan, Wells Fargo, or Bank of America. There's no doubt about it. They're definitely lagging behind. However, are they priced accordingly? Well, if you look at price to sales, they're currently trading at 1.74 price to sales. If you take a look at the non-laggers, JP Morgan is priced at 3.63, Bank of America at 4.2. Even Wells Fargo is priced at 2.7. So they're priced as if they're twice as bad as JP Morgan, Wells Fargo, and Bank of America, which I don't think is the case. They're not twice as bad and, half as good, whatever you want to call it. The thing, if you also look at price to book value, they're trading at 0.7, literally trading at less than the assets they have. So the question is, 0.7 actually is meaningless without what's the competition's getting priced at. And if you look at the competition, you're going to find out that JP Morgan, Wells Fargo, and Bank of America is trading between 1.5, 1.7, pretty much double than what Citi is trading for. So basically across all metrics, they seem to be trading at half the price of these other banks. Although they still make nice margins, 30% net income, It's not as good as JPM with 36%. It's not as good as the Bank of America with 34%. It's actually better than Wells Fargo with their 26%. So they seem to be on par with profitability. They are getting better. Management is taking steps to fix the woes of the previous management. At the very least, I can make a case that they're not half as bad as the competition, because that's exactly where they're priced at right now, $64. Now, this is a company that's basically being very slightly shorted, 1.8% short interest, which means the majority of people are not shorting this stock. In fact, institutionals are pretty much 98% long on this one. It's also a nice dividend stock. Whatever happens to the share price, they just give you about 3% dividend, 3.2% last year. So it's a nice dividend play, nice exposure to banking. And I believe that's the whole point here. In investments, you want to try to get a good deal. You always want to invest in good company, obviously, but you want to try to get a deal. You want to try to get cheap, not to overpay. Now, I've overpaid before, God knows, many times, but I think that Citi is actually a good example of how to get it right. Because I think at 1.74 price to sales and 0.7 price to books, I think that this is a steal, especially if they turn things around, as I think they will. Now, of course, this is just my own personal opinion. This is not a recommendation. I'm not a financial advisor. This is definitely not financial advice. I'm not just saying this. This is not just a disclaimer. This is the truth. Now, this video is basically to kind of share with you my opinion and to stimulate you to do your own research. So if you find what I say interesting, go ahead, research Citibank or Citigroup or whatever you want to call them and find out if this is actually a good stock for you to invest in. Now, I don't know. You tell me in the comments below what you come up with. I'd love to hear the results of your research. Let's view it as kind of a homework for you. Let's hear the results of what you think below, and I'm going to try and respond to every single comment. Not promising anything, but I'll try, because this is kind of, I feel like I'm responsible for these homework. So let's see what you guys come up with. Maybe you just type below, hey, Tom, you have no idea what you're talking about. Let's see and find out. See you in the next video.